Which of the following best describes the primary function of derivatives in financial markets?
Here are your options. A. Speculation on future price movements. B. Reducing transaction costs and trading. C. Facilitating risk management through hedging. Or D. Enhancing market liquidity.
Take a moment to pause the video and decide. The correct answer is option C. Let's see why. The primary function of derivatives is to allow market participants to hedge risks by transferring them to other parties willing to assume them. Why are futures contracts considered superior to forward contracts in terms of counterparty risk management?
Here are your options. A. Futures contracts are traded on exchanges with standardization and clearinghouse guarantees. B. Futures contracts allow for unlimited modifications before expiration. C. Forward contracts provide better liquidity than futures contracts. Or D. Forward contracts eliminate the need for margin requirements.
Take a moment to pause the video and decide. The correct answer is option A. Let's see why. Futures contracts are standardized and traded through exchanges, reducing counterparty risk through the clearinghouse. The evolution of derivatives markets can be traced back to which of the following early financial innovations?
Here are your options. A. The introduction of credit default swaps in the 21st century. B. The establishment of the International Monetary Market in 1972. C. The use of forward contracts in European trade fairs in the 12th century. Or D. The launch of the S&P 500 index options in 1983.
Take a moment to pause the video and decide. The correct answer is option C. Let's see why. Forward contracts were used in European trade fairs as early as the 12th century, marking the beginning of derivative-like transactions. Which of the following factors has played the most significant role in the global expansion of the derivatives market? Here are your options. A. Reduction in government intervention in financial markets. B. Introduction of derivatives taxation policies. C. Increased central bank regulations on derivatives trading. Or D. Global integration of financial markets and technology advancements. Take a moment to pause the video and decide. The correct answer is option D. Let's see why. The growth of derivatives has been fueled by global financial integration and advancements in technology that reduce transaction costs. Which of the following statements correctly differentiates options from futures contracts?
Here are your options. A. Options contracts require buyers to fulfill their obligations, whereas futures do not. B. Futures contracts involve daily mark-to-market settlements, while options do not. C. Options contracts do not have expiration dates, whereas futures do. Or D. Futures contracts have a fixed premium, while options have variable premiums.
Take a moment to pause the video and decide. The correct answer is option B. Let's see why. Futures contracts require daily mark-to-market settlements, whereas options involve an upfront premium and provide the right but not the obligation to exercise. What was a key reason behind the introduction of stock index futures in 1982? Here are your options. A. To increase the trading volume of individual stocks. B. To allow investors to speculate on individual stock movements. C. To provide a tool for hedging against broad market fluctuations. Or D. To replace traditional stock trading with a derivative alternative. Take a moment to pause the video and decide. The correct answer is option C. Let's see why. Stock index futures were introduced to help investors hedge against broad market movements rather than specific stock price fluctuations. Why are OTC derivatives considered riskier than exchange-traded derivatives?
Here are your options. A. OTC derivatives are traded in large volumes compared to exchange-traded derivatives. B. OTC derivatives lack standardization and central clearing, leading to higher counterparty risk. C. Exchange-traded derivatives are always more profitable than OTC derivatives. Or D, OTC derivatives have fixed settlement dates, whereas exchange-traded derivatives do not.
Take a moment to pause the video and decide. The correct answer is option B. Let's see why. OTC derivatives are customized contracts without a central clearinghouse, leading to higher counterparty risk. In the Indian derivatives market, what was the primary role of the Gupta committee? Here are your options. A. To introduce futures trading in agricultural commodities. B. To create new options pricing models. C. To develop a regulatory framework for derivatives trading. Or D. To establish the first derivatives exchange in India. Take a moment to pause the video and decide. The correct answer is option C. Let's see why. The Gupta committee was formed to develop a regulatory framework for derivatives trading in India. A trader who buys and sells derivatives contracts with the aim of making short-term profits without underlying exposure is known as a...
Here are your options. A. Hedger. B. Speculator. C. Arbitrageur. Or D. Investor.
Take a moment to pause the video and decide. The correct answer is option B. Let's see why. Speculators take positions in derivatives based on expected future price movements without any underlying exposure. Which of the following derivatives instruments is specifically designed to exchange future cash flows between two parties? Here are your options. A. Forward contract. B. Futures contract. C. Swap. Or D. Option. Take a moment to pause the video and decide. The correct answer is option C. Let's see why. Swaps involve an agreement to exchange future cash flows based on predetermined terms. If an investor wants to hedge against a potential decline in stock prices, which derivative strategy should they use? Here are your options. A. Buying a call option. B. Selling a futures contract. C. Writing a put option. Or D. Buying the underlying stock. Take a moment to pause the video and decide. The correct answer is option B. Let's see why. Selling a futures contract allows an investor to hedge against a decline in stock prices by locking in a future selling price. Which of the following is an example of arbitrage in derivatives markets? Here are your options. A. Buying a stock and simultaneously selling its future at a higher price. B. Buying a put option and selling a call option on the same stock. C. Entering into a swap contract to exchange interest rates. Or D. Holding a derivatives position until expiration without trading. Take a moment to pause the video and decide. The correct answer is option A. Let's see why. Arbitrage involves taking advantage of price discrepancies between markets to earn a risk-free profit. What is the major risk associated with derivatives trading that is not present in traditional cash market trading? Here are your options. A. Regulatory risk. B. Price volatility. C. Leverage risk. Or D. Taxation risk. Take a moment to pause the video and decide. The correct answer is option C. Let's see why. Derivatives trading involves leverage, which magnifies both potential gains and losses compared to traditional cash market trading. In an options contract, the premium paid by the buyer represents. Here are your options. A. The right to enter into the futures market. B. The maximum possible profit the buyer can earn. C. The price at which the option must be exercised. Or D. The cost of acquiring the right but not the obligation to buy or sell the underlying asset. Take a moment to pause the video and decide. The correct answer is option D. Let's see why. The option premium is the cost paid by the buyer to acquire the right to exercise the contract without obligation. The primary purpose of a clearinghouse in futures trading is to... Here are your options. A.
match buyers and sellers directly. B. Act as a counterparty to both sides of the transaction, ensuring contract fulfillment. C. Determine the fair price of futures contracts. Or D. Regulate options pricing.
Take a moment to pause the video and decide. The correct answer is option B. Let's see why. Clearinghouses mitigate counterparty risk by acting as intermediaries to ensure contract settlement. A trader who expects increased market volatility but is unsure of the direction of movement should use which strategy? Here are your options. A. Long straddle, buying both a call and a put option. B. Selling a futures contract. C. Buying a single stock. Or D. Selling a put option. Take a moment to pause the video and decide. The correct answer is option A. Let's see why. A long straddle involves buying both a call and a put option, profiting from significant price movements in either direction. What is the major limitation of forward contracts compared to futures contracts? Here are your options. A. Forward contracts cannot be used for risk management. B. Forward contracts lack liquidity and standardization. C. Forward contracts do not have counterparty risk. Or D. Forward contracts are always more expensive than futures. Take a moment to pause the video and decide. The correct answer is option B. Let's see why. Forward contracts are privately negotiated, making them less liquid and standardized than exchange-traded futures. A risk faced by all derivatives traders, regardless of their strategy, is.
Here are your options. A. Operational risk. B. Credit risk. C. Default risk. Or D. All of the above.
Take a moment to pause the video and decide. The correct answer is option D. Let's see why. Derivatives traders face multiple risks, including operational, credit, and default risks. The key characteristic distinguishing swaps from other derivatives is.
Here are your options. A. They are exchange-traded. B. They are only used for speculation. C. They involve periodic cash flow exchanges. Or D. They require upfront payments like options.
Take a moment to pause the video and decide. The correct answer is option C. Let's see why. Swaps involve exchanging cash flows over time based on agreed terms. The introduction of derivatives in India was primarily driven by. Here are your options. A. Increased speculative interest in markets. B. A need to improve price discovery and risk management. C. Government intervention to regulate financial speculation. Or D. The elimination of short-selling restrictions. Take a moment to pause the video and decide. The correct answer is option B. Let's see why. The derivatives market in India was introduced to enhance price discovery and provide risk management tools.